In the coming weeks, Congress will continue to discuss the debt ceiling, with both sides in fierce debates about government spending levels. According to the Treasury Department, the debt ceiling is the total amount of money that the United States government is authorized to borrow to meet its existing legal obligations. These obligations include Social Security, Medicare, interest on the national debt, tax refunds, and many other expenses. In simple terms, the debt ceiling caps the amount of money that the United States Treasury is authorized to borrow. In a September 8th letter to congressional leadership about the debt ceiling, Treasury Secretary Janet Yellen said, "A delay that calls into question the federal government's ability to meet all its obligations would likely cause irreparable damage to the U.S. economy." Okay, that sounds scary. So what exactly does she mean, and what can be done to prevent this worst-case scenario? Today on Government Explained, we'll take a closer look at the U.S. debt ceiling. To explain our current situation, we need to go all the way back to 2019. In the summer of that year, Congress passed the Bipartisan Budget Act, which, among other things, suspended the debt ceiling through July 31st, 2021. Since this suspension expired several weeks ago, the Treasury is no longer able to borrow to meet its obligations, forcing it to use its cash reserves. It's estimated that the Treasury had a cash balance of roughly $450 billion when the debt limit suspension expired, which sounds like a lot, but given the scope of government spending, would only last a couple of months. If these reserves run out without a debt ceiling increase, this would trigger what is known as a default. In simple terms, default means that a country is unable to pay its debts. You see, government spending that is outlined in annual appropriations bills and other legislation that Congress passes is legally binding. This means that no matter what, the United States is required by law to meet that obligation. When Congress authorizes spending that exceeds its revenue, which is pretty common now, the government must borrow to make up that difference. The debt ceiling prevents any additional borrowing, leaving the Treasury Department with far fewer options to meet its obligations. Since August 1st, the Treasury Department has not been able to borrow to pay for federal programs. Instead, they've resorted to using their $450 billion in cash reserves, and if Congress does not approve a debt ceiling increase, the American economy is in a bad situation. Admittedly, this sounds pretty dire, but the United States has actually been here before. Just 10 years ago, the US government had a similar crisis that brought us far closer to default than we currently are today. In 2011, the Republican-controlled Congress opposed raising the debt ceiling and came within just 2 days of default. On August 2, 2011, the Budget Control Act was signed into law, putting an end to this debt ceiling crisis. This bill was a compromise between Democrats and Republicans who agreed to raise the debt ceiling in exchange for several measures aimed at reducing the country's budget deficit. Though this event fortunately did not end in default, it did have a lasting effect on the economy. Most notably, this impasse led credit rating agency Standard & Poor's to downgrade the United States credit rating from AAA to AA+, marking the first credit downgrade in American history. It also had an impact on the stock market, kicking off the most volatile week for stocks since the 2008 financial crisis. Secretary Yellen has recently stated that they expect to run out of money sometime in October, so Congress will likely vote on this in the coming weeks. A vast majority of House and Senate Republicans have already publicly opposed a debt ceiling increase. Though it's largely symbolic, raising the debt ceiling would not be popular with some voters because it could be viewed as yet another irresponsible use of tax dollars. Political messaging aside, this is a dangerous bargaining game to play. Failure to raise the debt ceiling would result in a default on government debts, significant reductions in important government programs, and other harmful ripple effects throughout the global economy, far worse than we experienced in 2011. If you haven't already, please like and subscribe for more content like this. Thanks for watching.